Hello, everyone. Very warm welcome to today's Blockchain and Innovation Circle. My name is Gzime, and I have the pleasure to moderate today's big session. So today we will talk about some trends and recent developments and in the crypto space in general. Today's session is titled Facts and Forecasts by Bitcoin Suisse, and I'm super happy and excited to have Dominik Weibel with us, who is head of research at Bitcoin Suisse. He will provide us with deeper insights into the current market landscape, trends, expectations for the broader digital asset ecosystem, and so on. Before we kick off the session, feel free to post your questions if you have any in the Q&A section. At any time during the presentation, we will get back to it in the end during the Q&A. Yeah, Dominik, with that, I would like to hand over to you for your presentation.
Hey, thank you, Getsima, for the kind introduction. Do you see my slides already?
Yes.
Okay, so we are very excited to be here at the Blockchain and Innovation Circle. Thanks for having us. We prepared some very insightful topics, hopefully, and yeah, happy for everybody that is joining. And also, as Getsima outlined, don't hesitate to post some questions if anything is unclear. I would say we dive right into the topics. As you know, Getsima mentioned it, it will be today somewhat a rear view mirror, but also we will also dive deep into our projections that we published in December with our Outlook 25. It's our flagship publication. And as you know, it's already February, but it was already a wild ride in crypto. If you think about the Trump and Melania meme coins, also the Central African Republic launching a meme coin, along with Milei from Argentina. So these are crazy developments that nobody would have thought in 24. And then just recently, last week, we also had the biggest hack in not only in crypto history, but overall in internet history with 1.4 billion in dollars siphoned away to the North Korean Lazarus group. So there were quite some, it was very eventful already. And today we dive into some topics that are related to these events. So I prepared 4 key areas that we dive into. We will look into some regulatory developments. We will dive into institutional entries that are currently accelerating. Then something that might be interesting to many of you, we will provide a cycle performance outlook. So what do we think, according to our models, will Bitcoin and its peers perform in the remainder of the months in 25? And obviously, since risk-on assets are always linked to macro conditions, we will also dive into some macro conditions. We start with the most obvious, or the most impactful event, which happened in November 24, with the President-elect Trump basically winning the US elections. And this basically now means to the entire industry that the most capital-heavy economy globally now comes from tight restrictive oversight into full-on crypto embracement. This map basically shows you the different states. And as you see by the values on the right bottom-hand side, now not only the House of Representatives, but also the Senate is largely tilted into crypto's favor. And we were a little bit skeptical before Trump moved into the White House, basically not sure if Trump really follows what he said before. But as it appears today, with the executive order that we highlight later today, and all of his other actions, it seems like he's walking the talk. If you think about the administration and how he stacks the different agencies, they are all like largely pro-crypto candidates. Think about the new crypto czar, David Sachs. In the Treasury, we have Scott Bessent, very vocal about crypto. We have the Commerce Secretary with Howard Lutnick, also being pro-crypto. Obviously, Cynthia Loomis, who's now chairing the Senate Banking Committee on Digital Assets. And then Hester Pierce, who's also like basically guiding the crypto task force. And just recently, we now also have a pro-crypto candidate in the SEC, which is Uyeda, and also in the CFTC just recently announced. So basically, what I want to highlight, the entire agencies and administrations went from basically this more hostile environment towards a very pro-crypto environment. And we believe that this is not digested fully yet by the markets. And obviously, regulatory things come with a somewhat inertia. It will take a couple of months until we see things really materializing. Maybe we start with diving into the executive order from President-elect Trump. This is something that I want to highlight some points that stood out to me. So it basically is geared towards establishing strong support for digital assets, but it also prohibits a CBDC, while in many other jurisdictions, CBDCs gain a lot of momentum. So this is kind of a divergence to many other countries. This executive order basically mandates all of these pro-crypto, quote unquote, agencies to create a working group around digital asset markets. And it also mandates now for the first time to create a new regulatory, federal regulatory framework that is due within 180 days. That means we expect something to be there within the first half of 25. So only a couple of months to go until we have more clarity on that field. And then when you value some core properties of crypto, obviously there's some things that really resonate with me in this executive order, which is, for instance, protection of transactional freedom and self-custody, and also finally and eventually ending this whole Operation Choke Point that was largely geared towards being very hostile towards the crypto industry. So all of these like hostile aspects are ending, while a lot of positive things are emerging when it comes to regulatory headwinds. So we believe that this is something that really yields really constructive long-term regulatory tailwinds for the entire industry. And this might also swap over to other jurisdictions. Speaking about other jurisdictions, here I wanted to highlight just finally one small note on the executive order. It also asks this working group to evaluate the creation of a national digital asset stockpile. Two things worth highlighting here. The first one is it doesn't state Bitcoin, vanilla Bitcoin only. So it will be a basket around digital assets. And the second thing is stockpile, not reserve asset yet, meaning it does not imply that they add new crypto assets, but it does imply that they take distribution from currently holding digital assets from the table. And this table basically shows you the different crypto assets that the US government currently holds. Mostly, the source is mostly seizures. But now, speaking of other jurisdictions, also including the EEA, we saw a lot of calls for major crypto policy input in 24. Most notably, obviously, MiCAR entered into full effect in the end of 24. It's basically the first comprehensive regulatory framework for crypto assets, and it basically touches the crypto assets itself, but also obviously the related service providers. So we now have a harmonized regulatory environment, something that we can build upon. That was clearly needed, and we view that as an overall positive development. On the bottom hand slide, you basically see the different topics there that stood out most. The most important, the key topic was market regulation, and then followed by stablecoin or illicit finance. Ranking lowest, as you see, is energy and climate. And this also goes hand in hand with, for instance, Bitcoin mining operations that now have the largest share in renewable energy amongst all industries. So I guess this energy and climate topic will continue to wave, to be honest. Then what was outstanding to us was basically that the European Union and especially the United Kingdom were very engaging with the crypto industry. So we had like a lot of engagement from the EU banking authority or financial conduct authority from the UK. And as you see on the bottom right, basically the European Union and the UK were most engaging. Overall, I think these are, as I mentioned earlier, very positive developments. There's a clear demand for engaging with the industry. And I guess like what we see in the US, this very progressive approach now to crypto, like this entire plot twist, might also induce other jurisdictions, including the EEA, to be more progressive as well. Now we basically dive into the area of like how do sovereigns now approach, and especially institutions now approach the crypto industry. Here basically we highlighted different eras when it comes to reserve assets and currencies. As you see, we went from the commodity era via paper era, Bretton Woods with the gold standard, to fiat era. And currently, we believe that we entered the digital era, basically where we have like very new pillars that enter the financial system, such as tokenized dollars that are a huge success story within the crypto industry. We have this notion of on-chain risk-free rate. When you think about treasury yield, this could be something that where you see parallels when you think about staking rewards. When it comes to reserve assets, we see Bitcoin currently being highly discussed. It's very a controversial topic that many sovereigns and also on the non-federal level are discussing. We have this huge area, which is tokenization, where you can basically make very illiquid assets liquid, have way higher inclusivity, have like 24/7 markets, and basically can achieve like no borders. We see that not only for tokenized dollars, but also for real estate, for US debt, for private credit, and also many other areas that are like highly interesting. And lastly, we have like completely autonomous programmable protocols running on chains such as Aave, which allows you to lend without any intermediary. So these are like all highly exciting areas to monitor in the years ahead. And we believe it has a transformational force to the entire financial system. If we stick to Bitcoin and how it currently performs on different balance sheets, we see that there's this new reality for which pockets does Bitcoin flow to. We now see corporate, institutional, and sovereign Bitcoin supply accumulation, which is actually accelerating across the last couple of years. As you see in this chart, basically, we now have almost 14% of the entire Bitcoin supply in ETF, government, and corporate pockets. And just in the last 12 months, if you think about it, we had the spot ETF approval of Bitcoin in 24 January. And since this time, they accumulated more than 1.2 million in BTC within these ETFs. At the same time, we now also see public and private companies increasingly adding Bitcoin to their balance sheet. Think about Microsoft, for instance. This is a trend that is really sustaining currently and also accelerating. And we don't think it lost steam yet. It will be something that is likely also touching many other companies. And it's very interesting to see, because we went from retail to hedge funds, VCs. Then in the beginning of the spot ETF approvals, I think we have more family offices and registered investment advisors basically approaching the space. And now we went the whole distance and talk about pension funds, but most importantly also corporations and sovereigns, or on the nation state level. And what we recently see is basically that governments also approaching this, for instance, via sovereign wealth funds. We might see this in the US. We saw it with Abu Dhabi, basically stating that they are exposed with almost 500 million in a Bitcoin ETF position. And if you think about it, the top 10 sovereign wealth funds manage 9 trillion in assets. Only one currently has exposure to Bitcoin, and we believe that this is likely changing in the years ahead. But aside from sovereign wealth funds, you can also think about stockpiles or reserve asset status that is likely next. Why is it likely next? Basically, in these two tables, you see different nations, but also non-federal initiatives that are basically exploring Bitcoin as a reserve asset status. So basically what you see, there's really growing momentum, not only in the US, but also other countries to adopt Bitcoin as a reserve asset, as a strategic reserve asset. On the right-hand side, you see we now have like 24 states within the US which introduced a strategic reserve bill. By the way, one of them, for instance, is Texas, which is a top 10 economy in the world. So we are talking about very capital-heavy players that are, let's say, close to initializing Bitcoin as a strategic reserve asset. So as outlined, the many countries and states approaching this, and you might ask why. There are many positives, many benefits. For instance, if you think about Russia and China, their recent recognition again of Bitcoin as property, it basically allows you to be financially sovereign. So you don't have to deal with any stuff around SWIFT, for instance. Then the strategic reserve asset might also provide a tool against the mounting sovereign debt challenges that we see in the US. So there are like various arguments to establish this asset as a reserve asset, and obviously the historic performance, as well as the reduction in volatility, the risk-adjusted returns, the compound annual growth rate, are obviously also drivers to look into this, because it's an attractive asset, and not only retail nowadays understands that exposure might make sense. If you think about the current exposure of different countries, we created this table here where we basically highlight which countries actually already have exposure to Bitcoin. And it's quite a long list already, which is led by the US with more than 200,000 in Bitcoin. And as you see, we now have around 14 countries that hold Bitcoin, and importantly, 47 countries improved access, meaning via, for instance, regulatory improvements. As you see in the source on the right column of this table, that most countries do not access Bitcoin via a direct buy yet. So as you see, they mostly get it by seizures. Alternative routes are also, like, for instance, state-funded mining operations, or for instance, exposure through state-owned sovereign wealth fund, which links to Norway, for instance, or Switzerland, which have exposure via, like, indirect exposure via equity, for instance. I guess one of the important points here is the US is not only very vocal both on the state level and on the federal level. They already have the largest exposure, and basically can afford to be very vocal about a strategic reserve asset status for Bitcoin because of their of the dollar supremacy. This leads us basically to the institutional avalanche or institutional entries that we observe in the last months, last years, but increasingly in the last months. What is interesting here is basically, if you think about retail or alternative crypto assets outside of Bitcoin, the sentiment is very, very bad. And like, since I'm in the space, I never observed like such a major divergence between like institutional sentiment to retail sentiment. Institutions are like, most of them like are nowadays very vocal about crypto, about tokenization, about Bitcoin as an asset class, about about having Bitcoin in your portfolio as a diversifier. While on the retail side, it's very muted sentiment due to the fact that crypto assets outside of Bitcoin really lagged in the last couple of months. Before we dive into some of the adoption highlights for institutions, I wanted to briefly highlight like, why are institutions and also obviously other entities now approaching this space with such a high pace. In this table, you basically see it's our periodic table of major asset classes. You basically see the worst to the best annual return from bottom to top. And on a horizontal axis, you see different years ranging from 2013 to 2024. And what immediately falls into your eye is basically the red top row, which is Bitcoin, basically implying that it 9 out of 12 years, it outperformed any other major asset class, also by huge margins. You see that even in 24, we had like 121%. I guess what is currently getting really a momentum and might become a sustained trend is also that gold is performing very well. I will highlight a chart in the next couple of slides. So we see there's this notion of store value assets being very attractive nowadays for various reasons. So as you see here, Bitcoin is very attractive from a performance perspective, but it also, for institutions and investors, performance is not everything. You also want to have a non-correlated asset in your portfolio, and you also, in the best case, do not want to have too high volatility. And basically, Bitcoin currently serves all of these three purposes. In this chart, you basically see the 3-year correlation matrix. It clearly indicates that Bitcoin is the least correlated asset across these major asset classes, among them bonds, commodities, equities, in emerging markets, or US gold and real estate. So we are talking about an average correlation of only 0.05. And this obviously basically highlights that it yields substantial benefits as a diversification tool within a traditional portfolio. And as I outlined earlier, many players start to pick up on the fact that this is something you really want to have in your portfolio. Lastly, is the volatility. we had this chart in our Outlook publication. It basically shows you this displayed in this red band is basically the confidence interval of Bitcoin's volatility. And what we see is basically that it's pretty much compressing across the last across the entire history. We started with a very volatile but really not capital heavy asset. And now since it becomes larger and larger and more institutional players take part in the markets, we see that volatility is really diminishing. At the same time, obviously, with lower volatility, we see diminishing returns, meaning these asymmetric returns will also compress across the next couple of years. But what is interesting is that we now have a more stable asset, which yields very attractive returns, very attractive risk-adjusted returns at a rather low volatility, which is comparable to different tech stocks, as we highlight here with the lines displayed in gray. What is interesting is like, in our view, the most important aspect, obviously, the market cap of Bitcoin is now way higher. This leads to higher price inertia, but we think that institutions also have a major part of this diminishing volatility. They provide really consistent demand side flows. They basically introduce rebalancing effects into the volatility and the price performance of Bitcoin, meaning if the price goes up, many portfolios scale out of Bitcoin and vice versa, which also tends to dampen these market moves. We have very sophisticated players nowadays. 60% of hedge funds do participate in Bitcoin markets, and these historically tend to soften up, like, let's say, very aggressive market moves as well. And overall, we just have, let's say, a consistent demand, while let's say on the sell side there's not too much happening. So basically these were the three core pillars that make this asset and this asset class overall attractive to institutions. We have high risk-adjusted returns, we have a nice compound annual growth rate, and we obviously have a great diversifier, which implies that we are dealing with a new asset class. On the adoption side of institutions, this table is geared to show you how many of the big players are already offering different crypto services. We are talking trading, custody, crypto funds, ETPs, or payments and tokenization. And as you see, basically all of the big players nowadays take part in this crypto industry. They want a share of the cake. And to me, it's always fun to highlight that JP Morgan, if you think about Jamie Dimon, he was very vocal, very anti-crypto, let's say, but JP Morgan is basically the only entity that ticks all boxes. So there is a kind of a divergence between what is Jamie saying and what is JP Morgan doing. And this week we also had Citadel, the 64 billion asset manager, now also entering the crypto industry in terms of trading and liquidity provider and market maker. I need to add this to this table, but basically, let's say maybe the last big player that is missing here. So overall, the picture I like to paint is that basically all of these corporate moves really indicate or imply that we are dealing with a large institutional onset. They are really approaching the space at a high pace. And basically one of the best proofs is also the demand for the ETFs. We now have, like, as I outlined earlier, like 1 million Bitcoin in ETFs, more than 120 billion, depending on the price, obviously, I need to check, but I think around more than 100 billion for sure in these ETFs, which is a huge success story. And obviously, outside of Bitcoin, there's also a second institutional asset that got approval, spot ETF approval in 24, which is ETH. But ETH was a little bit, let's say, muted the performance was not really attractive across the last couple of months. But what we identified here, you see basically the ETH ETF flows, and they were really negative, really like not convincing until the US elections happened, which are highlighted here with the arrow in November. And basically from this point onwards, ETH ETFs started to perform very well when it comes to net inflows. And we derive from that ETH might benefit disproportionately from the new Trump administration, because from a regulatory standpoint, it had less clarity. And we believe when you follow the recent activities from New York Stock Exchange, for instance, there's a high likelihood that we see Ethereum staking ETFs being approved, meaning you now get access to staking rewards within your ETF vehicle, which was a huge opportunity cost as an investor and might have muted the flows earlier. Maybe fun fact around the ETFs: there's three among all spot ETFs. Among all ETFs, 3 Bitcoin spot ETFs are now in the top 100 within 1 year. So we're still in the area institutional adoption. Aside from the offering these different products, tokenization is probably the major area to monitor. Here we basically highlight how stablecoins currently create a lot of demand for US treasuries. It's now the 18th largest holder above South Korea, Mexico, and Germany, with almost 130 billion in US debt in their pockets. And they basically create a lot of revenue based on these treasuries, while not distributing them currently to stablecoin holders. But this is something that gains traction as well with for instance, the BlackRock vehicle, BIDL, which basically allows you to access treasury yield via an on-chain solution. So overall, stablecoins really become a driving force of the adoption area in crypto, which is nice to see. And it's also, like most interestingly, it's a huge vehicle for the dollar. If you think about FX reserves, international loans, or payments, if you think about SWIFT, usually the dollar hovers around 60% of market share. In stable coins, when you check the transaction volume, the dollar has 99%. So this allows the US basically to not only create demand for the US debt, which is important given they have let's say the dollar's status as a global reserve asset is basically reducing in the last couple of years, and this really helps the US to make sure to basically protect dollar supremacy. It also is a great distribution tool. Think about Argentina, for instance, or nations that really suffer from monetary debasement. We see like very high adoption rates there, and all of them basically use tokenized dollars. So we stick with tokenization, but look into some of the other different tokenization area. And what we basically see in this chart is up only. It ranges from 21 to now 24. And what we see is that really commodities and US treasuries, also tokenized treasuries, not tokenized dollars, gain a lot of momentum. But they still only represent a fraction of the overall 27 trillion treasury market. So we are only talking about like around 3 billion in tokenized US treasury debt, while there's a 27 trillion market to explore. So we expect commodities, especially with the momentum of gold currently, and US treasuries to thrive in the long term. One area that we are very excited about are tokenized stocks and equity. We believe this is likely the largest growth area in the months to come, also based on a lot of demand from characters like Larry Fink, for instance. And we might see like a huge regulatory unlock on the tokenized stock front as well. Lastly, Basically, before we dive into some performance outlook, our call in the outlook was that we believe that financial giants will launch institutional rollups for various reasons. This chart basically outlines that it's very attractive to operate a rollup. You can have, like for instance, Space had 80 million in annual revenue, above 60 million in on-chain profit. But you also get like full control over different aspects such as consensus rule. You can have reversible transactions, which would have helped with the hack we saw this week. You can have built-in compliance features such as KYC or money laundering. So this is like highly attractive, and it also opens up the market to have like equity or ETF wrappers to basically distribute these assets and vehicles more globally, which basically adds to this revenue of the sequencer, of the rollup sequencer itself. Maybe important to highlight here, currently when it comes to tokenization, Ethereum is really the platform of choice for most of these institutions, but also other players are emerging, such as Ondu with their own sovereign chain, such as Solana, and also Avalanche is quite strong on the tokenization side. Now to the performance outlook. So here basically this chart shows you a very sophisticated risk model, which is basically made by a colleague of mine, Dennis. Kudos to you. It basically based on two different factors: dynamic on-chain cycle risk, which we call dynamic on-chain cycle risk, and dynamic cycle price risk. We can evaluate like where are we in the cycle, and according to our risk models, we highlight basically if you check the right hand side, the green price performance line of Bitcoin, it's very in the low risk environment currently, and we do not believe that we saw, also based on many other indicators, that we saw a cycle top yet. Despite basically macro conditions are not really prime currently. So for 25, according to these models, we project Bitcoin to trade around 180K, maybe even higher. But this is basically our conservative target. And again, like currently we have we see lower risk based on these models that we had at all-time high, or during the March all-time high at 70K, which is highly interesting. I highlighted this before. Here, basically, Bitcoin performed very well. Other cryptocurrencies, not so much. This chart is basically demonstrating that we see somewhat of a decoupling between Bitcoin and other cryptocurrencies. We have like different reasons for this. So the first reason is basically we have a large token dilution within the ecosystem. We now have, we are talking about 30 million plus tokens now. We have some valuation problems that might stem from BCs. Think about the ICO area. It was cut basically based on regulatory headwinds. And we transitioned into a more BC area where we saw like very high valuations being pushed onto the market for the not really for the benefit of retail participants. And then obviously the third one is macro conditions which are not really supportive for high risk on assets such as other crypto assets outside of Bitcoin, while Bitcoin still taps into some demand for store of value assets and basically resonates with the momentum that gold currently has. Interestingly, this kind of decoupling somewhat happened first around the ETF approval and the launch of Pump.Fun, which is known for the meme coin mania inducing it, and then around the US elections. This chart basically highlights the extent of the current altcoin crypto asset dilution. We have now, based on scalability unlocks, rapid token creation that really alters the whole altcoin meta. For instance, 2017, we had like 12,000 tokens. 21 in around cycle peak, we had 1 million. And currently we are inching closer to the 40 million mark. So this is problematic in the sense that we still deal with somewhat the same liquidity conditions, and these now have to spread towards a way higher amount of tokens. And at the same time, the attention, or basically the capital rotation, is also increasingly fast, which is also induced by this high amount of different tokens. At the same time, we have there's this notion of extractive players. I'm also referring to, let's say, sophisticated players that really basically have insider information on the different token launches, but also operate in a sophisticated fashion when it comes to MEV and basically sandwich attacks and the like. Basically, this leads to this notion of there's a lack of wealth creation, and is something that is stifling the current environment. One area that is largely benefiting from this are perpetual exchanges. What we see basically here is that centralized exchanges, they cannot keep pace with the amount of listings, because it's just too much tokens. On a decentralized exchange, for instance, you can list any token with it's more or less plug and play. And centralized exchanges, when you think about the SEX to DEX ratio, or the DEX to SEX ratio, we see all-time highs, we see more momentum, we see market share being eaten of centralized exchanges from decentralized solutions, which is something I'm personally very excited about. So we had the token dilution aspect for altcoins. Now we also have this strong bid towards store of value assets, and Bitcoin in particular, because it has a very established narrative if you compare to other crypto assets. When you think about gold, we have this strong gold bid from central banks that really try to diversify their reserve assets into something that is not related to the US dollar. And in our view, Bitcoin really benefits from similar factors, being a neutral, scarce asset that also comes without counterparty risk, and maybe an even scarcer supply. On the supply side, a fun fact, we already dealing on the gold side with supply constraints. I think even some gold markets in London already defaulted on physical deliveries, which is something to monitor, especially given the accelerated demand for gold. I guess the takeaway here is that Bitcoin and gold really eat a lot of mind share right now when it comes to store of value assets, while capital is also constrained from rotating into altcoins, because a lot of capital also sits within these ETFs, which is also different to previous cycles. However, we still think that Bitcoin dominance is peaking throughout this cycle, and at some point we will have an altcoin rally. We saw this in the previous cycles as well. Altcoins are really known to lag behind Bitcoin, and something that is like the most important factor in our view is non-supportive macro conditions, but they will likely also improve. Maybe just before we dive into the macro aspects, this chart I found highly interesting from River. It basically highlights again like how Bitcoin really performs closely to gold, despite having a lack of liquidity. So what you see in the previous two cycles, we have had large increases of global M2 money supply. This time it's really muted, but the performance is still quite attractive, I would say. On the macro side, we observe the following. We currently still deal with somewhat muted liquidity condition and also M2 money supply. We tend to think that this might continue in the short term, but in the mid to long term, we believe the global liquidity will improve and basically stimulate risk-on assets, among them other crypto assets outside of Bitcoin as well. And if you think about the recent Fed speech from Powell, there was this clear notion that there won't be any QE. In our view, no QE does not mean no risk-on environment. There are other tools to stimulate risk-on assets, such as lower bond yields. This is something we expect to happen via, for instance, capping the spending in the US, via, for instance, what Elon Musk is doing with Doge. This should lead to basically issuing less debt, and therefore we have less supply, and therefore the bond yields should drop. We also already see like that the Treasury general account is already injecting somewhat liquidity, and we might have seen the dollar top, because it performed very strongly in the last couple of months. This is basically, you see this in this chart. I think I'm running out of time. I have like 2 slides left. I make this quick. This chart basically shows you the correlation between the DXY, the dollar index, and Bitcoin. And what we highlighted here is basically, usually in cycles, it highly correlates with a weak dollar. And as you see on the right-hand side in this chart, the dollar is not really weak. The M2 money supply did not really grow, but Bitcoin still performed well. And we think if we manage to get a weaker dollar, which might happen based on the current actions of Trump, we might see an explosive growth, not only in Bitcoin, but also in altcoins. And one of the drivers will be easing liquidity conditions, not on the fiscal side probably, but on the monetary side. And before we finish this talk, basically on the monetary side, I think one very important, or very, let's say, interesting aspect is what Doge is doing. This chart is basically showing you on 4 different levels how different constraints in spending might impact GDP levels, unemployment, inflation, and the Fed funds rate. The takeaway is basically depending on how much Doge is capable to spare, we will see like probably a stimulus or Doge basically inducing a higher unemployment rate, which will basically incentivize the Fed to cut, but we will also see like basically lower inflation. And I close this with a positive message here. The chart is basically showing you performances of the S&P across different years. What we see currently, February is historically really a weak month, especially in post-election years. But in the next couple of months, we expect the seasonal weakness to fade. And have some more macroeconomic support for more risk on assets. Also, don't forget, the tech in crypto is better than ever. We have a better regulatory climate than ever. Institutional adoption is really accelerating, and corporations as well as nations are buying crypto assets. So overall, everything is really positive. This is our range of publications. I share this later. And with that, thanks for your attention.
Thank you very much, Dominic, for the super interesting insights. You had some powerful charts and figures, which were speaking for themselves. Thank you for that. Maybe I can kick off the Q&A session with a question from my end. Maybe in like 2-3 years, what is like the best and worst case scenario you can think of, especially like regarding the current geopolitical situation? Like we have Trump, which really wants to push the emerging tech space, and So what's your take on that?
So the best and worst case scenarios. Oh, that's a tricky one. I guess I'm like mostly a very optimistic person, to be honest. I'm not sure. There are a couple of threats, like that. Some of them are like almost exclusively geared towards crypto. If you think about quantum computing, for instance, it might be a threat, but all of the teams are perfectly aware. We have the timeline estimates. I don't think this will pose a large threat. On the geopolitical side, I do not think there's any like immediate big threat that we should be like highly concerned about. We have highly deflationary dynamics at play when you think about AI, when you think about more efficient production. So I guess, and we also like heading into an easing cycle. So overall, I would say like I'm really not too concerned overall when it comes to markets and especially risk on assets, given these points, and I'm like more optimistic. And I guess like one of the in a good scenario for me would be if we find balance between, I guess, our jurisdictions here around the EEA could be a little bit more progressive when it comes to the regulatory environment. That is my, let's say, my private take. While on the other hand side, I feel the US is a little bit too progressive. And in my view, it would be nice to find some balance in between.
Interesting. Thank you so much. So we have a question which was asked. I will read it out loud. So it's what about the path for individual use, meaning payments and regulatory simplicity there, versus the CBDC ideas? Or asked differently, when does crypto land in the general public?
When does crypto land in the general public? I think this is already happening, as we outlined with stablecoins, especially. I think these are really like tools that are tremendously helpful for people that really suffer from high monetary debasement. If you think about like Venezuela or Argentina that are highlighted before, there the adoption rate, I mean, go to these countries, experience it yourself. You see like a lot of, I was recently, for instance, in, what was it? I forgot the name, to be honest. Georgia, it was Georgia. And there the crypto adoptions was incredible. And you would not think that. So I guess for many countries, also in some instances in Africa, in India, many people, like way more people have access to a smartphone than a banking account or even brokerage. So I guess crypto is already landed to some degree in our across the globe. And I also think there was one of the very impressive number. I think 8% of the global population already have exposure to crypto assets or use them, which is a huge amount of people. And if you check the data sets from electricity usage or internet adoption, Bitcoin and crypto assets, when it comes to active wallets, active users, really closely resembles these S-growth adoption patterns. So I believe maybe we are not like in a full-fledged adoption yet, but especially with these regulatory unlocks, I think it's just a matter of time until many people use them for a lot of very legit reasons. Just think about remittance services, for instance, and also this notion of disintermediation. It's really powerful, and I think this might will eventually yield a lot of adoption.
Thank you very much, Dominic. I think we do not have for now another question. I thank you a lot for joining us. Thank you so much for providing all the interesting insights. And yeah, maybe a quick heads up for the next Blockchain and Innovation Circle, which is happening on the 25th March. That Blockchain and the Innovation Circle will be around large language models. I mean, we saw just recently DeepSeek introducing a Gen AI tool, which is open source and developed at remarkable little costs. And so we will talk about, we will compare different models and talk about pros and cons. So yeah, I really...
Sounds good.
Dominic, just another comment which was just dropped in the section.
Yeah.
Are you able to share the presentation?
Yes, I will share the slides. I'll check with compliance, but there shouldn't be any problem.
Okay, perfect. In that case,
happy to do so.
Yeah, in that case, we are happy to share today's presentation. Thank you very much, everyone. Thank you, Dominic, and wishing you all a good day. Bye-bye.
Thanks for listening. Bye-bye.
Bye. Bye, Dominic.